Okay, hello everybody and welcome to the video about the COTrt reports which were available on my website through the Google Sheets. For years now, I started to publish this around 2018, and it was actually the very beginning of my journey with publicly exposing some of the things that I was working on. So this one is actually the one of the oldest models that I've made, and it served us for years now. And you might have noticed that the Google Sheets is no longer available. And the reason for that is, first of all, I wanted to move it to one place, so it will be available soon on as a part of my tools on emini.today, and it's not going to be in the form of Google Sheets because there is a lot of data now. We have like 5 years of data, and the charts are not so the charts in the Google Sheets are not so great. So it's gonna be much better to view this on the engine, on the chart engine that I'm using on my website. That's the one reason. And the second one is that I am actually going to reveal the model itself and the things that I needed to calculate this on a daily basis the way I did it. As you know, I want to first of all automate everything, and by the end of the year I just want to do as little as possible. So again, there will be two ways to access this. Either you want to have it for life, for your own, with the data, and you will be able to tweak, to research based on the general idea. So that's that. The Google Sheets is no longer available. I think the tool itself is going to be added this weekend, so I hopefully on Monday. It's going to be November 14, maybe 15, something like that. It should be on eMini, and it will be in a standard monthly subscription. But like I said, it will also be available as a part of ET Toolbox. So it's going to be one of the things in the toolbox. So in the toolbox you will get all these things plus the thing that I'm gonna talk about today, the midterm long-term asset managers positioning, and it's plus the strategy. For those who were with me from the very beginning, they remember that we had this major strategy which was actually called master strategy. I will show you in a minute how the P&L for this looks like. You will also get it in the Excel spreadsheet. So before I move on and talk about the details of this model, I wanted to talk about the background of this research sorry, and how it all started. So before I even got into analyzing options data and making models based on them, is I was heavily using the thing which is called a commitment of traders reports from CFTC, and most of you probably are familiar with this. It's the report which comes out every Friday, and it shows the positioning on previous Tuesday. And basically, you will have asset managers positioning, leveraged funds, small speculators, and so on. And you will see how long or short these participants are. So back in the day, I was doing some strategies around this data. But the obvious problem with this is that, first of all, it's just once a week, and then it is basically with a few days lag, because you get the data on Friday, which were on Tuesday. So it's a bit inconvenient. So once I started to get into the options data, one of the things that really struck me was how much one of the models that I made resembled the COT report on the E-mini S&P. And later on, of course, I found the reason why was it the case. But combining some options data, and at the beginning I was also using internals data, so the ticks and ADRs and stuff like this. I came up with a initial model which pretty much was giving me the sort of the COT report, but in real time. So every day with the real time data, because internals and options data, you have a real time feed for this. Like I said, later on, I dug deeper into the reasoning. Why is this even possible? And of course, the reason for this is pretty simple. The large institutions, large speculators, generally when they initiate a position, it's usually not intraday position. They will hedge themselves with options. So when they buy the market, they will also buy the protection in the form of puts. And vice versa, when they are selling the market, they will be buying calls. And this was something logical and reasonable. So I started to dig deeper into this, and that's how the model emerged. So I didn't need actual positioning in the futures market, which was reported with a delay and so on. I had it on the daily basis in real time. Of course, there was a matter: which data do you take? Do you take OI? Do you take volumes? Which strikes? And I had to test a lot of these different combinations. Now, having 5 years of data now, I think it's fair to say that there is edge in it. And it not only resembles the COT reports, it's not like a perfect resemblance, but it's actually, a lot of times it will show a better view on the situation, and it will give you a better signals. And I will show you in a minute how it looks like. But what I'm talking about is, if you look at asset managers and institutional, so the green line you will see that they went short. So the net short was exactly the first one here. Then they went long. So and then they shorted at the almost at the bottom. So in the case of the bear market, it really doesn't look so good. But on the options data, if you look for in a right way, if you look in a right way, how the hedging looked like, you will see that actual hedging of the positions looked a bit different. So let's get to the spreadsheet, and this is how you remember. For years, it looked like this. We had long-term speculators and midterm speculators. The reason I divided it in two is that the midterm, so the bit faster metric, gives a bit better timing, and it helps in certain situations, which I'm going to talk about in a minute. And also, to be clear, this model is as is for 5 years now. There wasn't any particular messing around with the calculations itself. The way I started doing it, the way it went on for all these years. And the reason why there is things like a 20-day shift is not something that I came up with through some optimization or something like that. A lot of the elements which are in this model are actually taken from people who were working in an industry. So the ex-dealers, so professional institutional traders, like a part of it is something which I deducted from the Anton Kriel's course on stocks and options. So the way I connected the dots, I think it's quite reasonable, and there is a very small amount of optimization, and the effect of this we can actually look at now. Okay, so the major metric is long-term speculators. So a long-term institutional traders, large traders, and you will see the same thing that you had on Google spreadsheets. I think it's much better visually presented in Excel, and you will be able to choose to show just last year or something like this, the full history, but with the possibility of just scroll around, so you will clearly see what's going on here. So this is the SPX, the black line. The metric itself is this red brown, and the most crucial part, which you didn't get in Google Sheets, is this green one, which is the same as the metric itself, but it's moved 20 days in the future. And this is what makes a difference, and it was in essence the master strategy. So what is the master strategy? Well, the master strategy is very simple. Once the what I call the LT effect, so the long-term effect, which is based on this metric, moved 20 days into the future. Once it just crosses the zero line, so it goes net negative, it means the strategy goes short. Once it goes above zero, it goes long. So it's constantly in position. So if you look at 5 years of data here, and this is the P&L, and of course all the calculations are in the data, which I will get to later on. So the red one is the S&P, and the blue one is a strategy based on long-term effect of the institutional hedging. So basically, in times of bull market, you're not going to get much more than what the market gives. But in periods where market was tanking, like this one here is the COVID, so you have a huge drop, as we know, and based on the LT effect, very simple strategy, just go long above zero, go short below. Well, the strategy made quite a good run. And then we go to the last bear market, which we are in now. You will also see that after some initial sideways action on the P&L, we have a quite nice up move on the strategy. And this here is a combination of the LT effect plus the gamma, which is over here. So once the gamma is above zero and long-term speculators are above zero, then we go long, and when it's below and the gamma and the LT is below, then we go short. So these two components have to be in the same direction. So if you look at the green line, you will see that it's pretty much the same, but there is a bit less of volatility in this strategy. So before I go further, I will pause the video here for those who are watching it on YouTube. And like I said in the beginning, you have two options to still be able to access this data. Next week, it will be part of eMini Today tools, or you can have the formula and all the calculations for yourself, and do the research or any use of it as you like. The data that you need are widely available on the internet for free, so you don't have to have any data feed. You can use like Yahoo Finance, you can use Thinkorswim platform, even a paper trading account. You want to just add the data once a day, and these are just 3-4 numbers that you will need, and it's very simple to maintain. So there is no problem with buying some external data fees or anything like that. This is EOD methodology. It was at the beginning a swing trading strategy for me but it also serves well if I'm not sure about the overall sentiment in the market, and this gives pretty clear indication in a bit longer time frame. So it helps a lot. That's why it's with us for all these years. I know some people use it extensively in their trading plans, and that's why I kept it available. So thank you for watching this part, and now I'm gonna go to the data itself and show you how you actually maintain and calculate the data. One more thing I wanted to add before I move on to the data itself. The moment I started looking into the options data is about 2016, 15, maybe end of 15. And nowadays you will see a lot of, software, a lot of people, a lot of analysts are, into the options data. Like back then, I think I was one of the first people who were actually using and publicly, sharing some stuff that I found in the options data. So you have to understand that back then, the options trading was not on the level, like it's way lower volumes, and it wasn't anything like we have today, when you have the SPX options with record volumes, you have SPY options with huge volumes, and even the ES futures options with a very large interest. And so the reason I'm telling you this is that there were no things like unusual whales or other vendors who are now having a great software to analyze the data. But the core thing that you can get out of this data is really unchanged, because the concept of hedging by dealers didn't change much. Maybe didn't have such impact back then, but right now it's huge. And but the models didn't really change. So if you are trying to find something in the data today, obviously from the intraday perspective, there is much more than the model I'm proposing here. But if you are looking at the overall market and the sentiment, there is not much, more than this. Even if you are using, let's say the gamma, and how much gamma is in the market, it doesn't really give you much more edge than this. It's a bit like with technical analysis. Whichever tools you use, you will have on average, you will have pretty much the same result after some period of time. So what I'm proposing here in this model is a quite simple approach, but even if we would go to much more sophisticated one, a much more sophisticated level, you will not probably, I would bet that you're not gonna get anything much better than this. So I believe this is a good start to to play with this data. You have some ground fundament in what I'm showing here. And of course, you can add like a volatility, VIX or VXV or whatever, and try to make the models for the volatility based on that. And it's actually a great direction, and it will help a bit with these results. But like I said, on the average, you will get something around this. This is like the total edge of this EOD data, so end of day, because like I said, on the intraday basis, it's a bit different story, and we have tools on Mini today, which are more focused on exploiting the intraday data, so like second by second, minute by minute data, and yeah, I mean, this is my thinking on the depth that you can go with options data. There are limits to it, and I've spent hundreds, or not, if not thousands of hours, figuring out the best strategies with EOD options data, and whatever I did, it looked maybe a bit better than this, maybe a bit less volatility, but in essence, that is the shape that you're gonna get. Okay, so now I'll move on to the data itself.